Hey, Mike here. I just did some selling in my portfolio, and I'll explain what went into that thinking and what I'm planning over the next 6 months, because that's really what's factored into this decision. There's a lot to it. It's going to take a little while for me to explain, but I was about 105% invested, and an hour ago, or well, actually over the past 20 minutes, I've gone to a 66% investment position. So 44% of my account is in cash. Now, I know the news is talking a lot about this fiscal cliff thing, and I mean, you turn on CNBC, they got a damn countdown ticker now. But in the end, I don't make my investment decisions based on news. I do it on the price action of the market and valuations. And if you think back to this summer, all the news back then was bad, in particular of Europe and Greece. And the market's gone up since then, and Europe and Greece have been the best things to buy. And I've kept all my positions there because I really don't want to part with them at all. But let's talk about the U.S. stock market real quickly. In my view, we're in the mature phase of a bull market. In the beginning of a bull market, that's where you see most of the gains. And we saw that in 2009. Just remember 2003, right? For a year and a half, that's where the big gains came. And then the rest of the big gains in a bull market actually come towards the end. In my view, we're basically, somewhere in the middle. And we've seen that from 2004 to 2007. We experienced a middle bull market. And that middle phase really is made up mostly of a trading range market. We've seen that the past few years where the market would go in a trading range, break out, then come back down. And what's been happening is each breakout is result in fewer gains and more sideways action. At some point, I think probably in 2 or 3 years, we will see a breakout and I think a rally up to all-time highs, and that'll probably be the end of the bull market. What this means right now, though, and this is key, is that at the moment, I really think the upside potential for the U.S. stock market is very limited. Not simply because of this bull market trend and the chart trend I'm telling you about, but the valuations of the U.S. stock market are very high. The cyclically adjusted PE is over 20, which is a high valuation. That doesn't mean it can't go up, but it means on a fundamental basis, as a whole, the U.S. stock market is overvalued. So from an investment standpoint, it's not very exciting. Now, there's sectors inside that are still cheap, banks, energy stocks, to name the two that are the most interesting. But as a whole, the U.S. stock market is overvalued. Okay, what that tells me is that if and I do think it will at some point, it breaks through. Once it does, though, break through the highs of last November, I don't think it's really going to go anywhere. It could go up to 1,500 or, right below it or right above it, maybe. But from here, the upside isn't, from about 5% or something. Okay, now here's the key thing. Let's talk about the fiscal cliff for a second. If the fiscal cliff happens, in my view, what most likely will occur is the stock market will decline into that event and bottom out and then go up. I don't think it'd be much of a decline. Let's get a more of a zoomed in chart here so we can talk about that. But basically, I don't think the S&P would go down to like 1390 or something, or 1380. I mean, the worst case scenario is the November lows, and the fiscal cliff thing is basically the first couple of days of January. And people are going to figure out, the market will figure out whether there's going to be a deal made or not. Okay, so this is what I'm telling you. If there's no deal made and fiscal cliff happens, the market will probably dip a little bit over the next 2 weeks, bottom out, and then rally up to up and through the fall highs. So how we play that? Simple. We buy at the beginning of next year. Okay, now let's say that there's a deal made, no fiscal cliff. What will happen then? Simple. The stock market will rally into the end of the year and probably the rest of January, but it will get toppy once it breaks these highs. It'll probably make a peak late January, early February, and then go through another correction. Either way, there's two things I'm thinking about. Short term, if the market declines, we buy, or I'm going to buy. If the market breaks out, hold on to what you got and be ready for a top in January, February. Well, either way, here's the thing. No matter what I think happens, or what does happen, I don't really know whether the fiscal cliff will be resolved or not. But whatever the case, it's my belief that we're going to see the stock market make a peak sometime when it breaks through these highs. Whether it dips first before it does it or just goes up, I'm not sure. That depends on the fiscal cliff. But either way, I think the market will be making a peak in this sideways market, not a peak like a bull market top, but a peak like we saw last year in the spring, or the year before in the summer, or the year before that. We've seen this happen over and over. And once that peak happens, I think the S&P will go down about 1,300. It'll go to its lower Bollinger Band. There'll be panic, fear. I bet you people blame it on a slow economy. The news will give you some reason to think and be scared, but the end is we're in a sideways market now, overall, for the U.S. stock market. So if I'm thinking ahead now, in the long run, next year, the money to be made trading the market in 2013 will be taking advantage of that dip when it happens. Whether the peak comes in January, February, or April, May, June, I don't know. Bottom line is money be made on the dip. And that was the case this year, right? If you think about it, the money to be made was right here, buying on the dip. And what were the best things to buy? Turned out to be the cheapest markets in the world, making major bear market bottoms, which was Europe, which I talked about and the TV said was crazy to do and hardly anyone did, but that was the key. The money to be made in 2013 is holding Europe, buying Europe, and probably commodities and gold. All right, now let's talk about commodities and gold because that's what I sold. I held all my positions in Europe. Well, let me show you Europe first. Let's just look at this one, for example. All right, here's a base. This is Austria. It's breaking out. It's entering a new bull market. I think this will be at 24 next year. And across the board, that's pretty much the story all over Europe. You have markets with cyclically adjusted P's less than 10, markets at a half or a third of the valuation of the U.S. stock market. You know, if long bases, it's a completely different situation. The upside potential is enormous for these markets. They're not in, 3 or 4 year long bull markets. I believe they're starting them. And right now, upside potential, I think, is in stuff like Ireland, which, in my view, has resistance here at 9 of a stage 1 base that's 3 years old. Once it breaks that, it's in a new bull market. So where the S&P 500's got upside of like 5%, the upside for these markets is, 100% or something in 2 or 3 years, 30% next year. Who knows? The Greece stock market doubled from its low, and I bought in here, and I'm up like 40% or something in it. I'm not going to sell this. I think it's things. This could be 100 in a couple years. I mean, that's the upside potential. Now, let's talk about commodities. This is GCC and what's going on in commodities. Okay, there's two possible. Commodities went into a bear market. They bottomed in the spring. They bounced up, and GCC's got resistance at 32. But now it's pulled back. It trades with the CRB index, which people more commonly talk about, so we'll flip to that. Resistance at CRB is 320. It's right here. Now I see one of two things happening here. First, it's been correcting now since September. It bottoms out, it breaks 320 and goes up to 380. Or it comes down to here and it's basically in a stage 1 base. It comes down to its lower Bollinger Band and breaks out next year and starts a new bull market. In other words, That could easily happen if commodities start to lag the U.S. stock market now, which they've been doing the past few weeks. So that trend continues. The U.S. stock market peaks out January or February or whatever, has a correction like I'm expecting in the first half of next year. If commodities continue to lag, they'll probably trade weak in the next couple months as they're just simply basing. And then in the second half of next year, break out of the stage 1 base and go into a big bull market. Now, I have a reason to think that may indeed happen, and that's that gold stocks have been trading weak the past few months. And if we look at gold stocks for a second and think about them, if you think about what I've been talking about the U.S. stock market, fiscal cliff or not, in my view, the short-term trend, the next 6 months, really 3 months, I think the current rally, which we saw start in June, is on borrowed time, whether it makes a new high or not. And in the first 6 months of next year, there will be a correction and a buying opportunity. That means that for other sectors, they have the potential to drop too. And gold stocks are acting weaker than the U.S. stock market. In my view, they bottomed here last year, and I bought here in August with the idea that they could be starting a new bull market just like Europe was. But they stalled out and they've corrected back down and taken about half their gains. They're acting weaker than the metal. They're acting weaker than commodities as a whole. That makes me think that they're not exactly in a bull market, but they're not in a bear market either. They're in a stage 1 base. Just like European markets were in a stage 1 base here. And they're now breaking out. So European markets are in bull markets, new bull markets. And I think the gold stocks are in something like this right now, a stage 1 basing process, which probably means they're going to act weak for the next few months or just not go anywhere and then break out after as the U.S. stock market has its next correction, and the second half of next year really go crazy. But for the next few months, I just don't think they're going to do much. And if you look at them, you know, they're already roughly, I'm not sure exactly, but you know, roughly 20% off their fall highs, and that means it would take a move of 20 for them to go into a new bull market. They need to break their fall highs. Okay, well, their upside potential on the gold stocks right now. Keep in mind, I'm thinking the U.S. stock market rally could potentially continue for a couple months at the most. That means the upside potential in here is the fall highs for the short term. I think there's a risk the gold stocks, the HUI decline of 400, maybe even go down to the lower 200-day Bollinger Bands. In other words, they're in a trading range. And I decided I wanted to sell in order to be in a cash position to buy later and stuff. So I sold the gold stocks because they're acting the weakest right now. I'm likely to be buying these back sometime next year. If you look at the 200-day Bollinger Bands for the HUI, you can see they're starting to come together. And they'll probably really come together in the next 3 months. That's typically what you see right before the start of a new bull market. So I think, I think the gold stocks are going to go sideways for the next couple months and then break out into a new bull market. What does this mean for gold? Well, gold's got resistance at 1800. If it breaks 1800, that's when it's really going to start its next big move higher. Just like it did here, right? When it basically broke 1,000. And I think that next move higher will last several years. We could see gold go to 5,000 an ounce. Well, for the next couple months, well, right now, that means to me gold's at a real critical juncture. it's either going to turn up and break 1800 over the next couple of weeks, or it's going to break short-term support, which is basically 1675, its fall lows, and then fall down to 1600 or 1500, somewhere between 1600 and 1500, along with the gold stocks correcting, and that would make a new low, and then we'd probably see it finally rally up and break through 1800 next year after a first quarter correction. So that pretty much follows the same pattern I was talking about the CRB index, right? It would come down too, make a bottom here and take off. Oil has the same story to it. Oil would come down to, below 80 and bottom out. And let's look at oil stocks because they actually have the same trend to them also. Oil, this is XLE. It'd probably come back down to this Bollinger Band and make a major buy point. And remember, oil stocks are very cheaply valued. It means that would be a good time to buy them. Gold stocks too. So, to some, it's a lot of complicated stuff. I'm going to write this out in reports over next week to explain this in more detail. I think it's easier to read this in some ways than to be told it, to understand it. It's somewhat easier for me to write stuff out too, when there's so many different angles to this and so many things to sum up here. Bottom line, Europe has been performing the best since the summer. No surprise there. It's starting a new bull market. The valuations are the cheapest. I don't want to sell any of my European positions, even if they dip back down. I don't think you should, we're not about to start a new giant bear market anywhere in my view, so there's no reason to go to 100% cash. That said, I think the money to be made next year, and that's really what I'm looking ahead to, is when the current rally in the stock market peters out, we get another pull back down to lower 200-day Bollinger Band, about 1,300 on the S&P 500. I think that's going to happen next year. As we go into this year, stuff's getting a little shaky. There's a possibility the market could dip down for a quick dip on the fiscal cliff, and so we ride things back up and see the top come. But bottom line, I think this rally will end next year that we're experiencing now, sometime in the first quarter. And then the money to really be made next year is buying on that next dip, that next correction. And I think the upside is very limited for the stock market. That's why I'm just taking a cash, going to about 40% cash. And I think the gold stocks are trading weaker. They're vulnerable because of that right now. I think they can dip back down to their summer lows. If they do, I think that's a great buy point for them, because I think they'll be completing a basing phase next year, probably by the summer, and starting new bull markets. So I'm really looking ahead. I don't care what the stock market really does the next couple of weeks personally. I'm holding on to my European positions. Market goes up, they're going to go up more most likely. If they don't go up as much, that's all right. I'm not really worried about, missing out on the S&P 500 going up 3 or 4%. I'm looking ahead. I'm coming up with a game plan for these markets next year. That's what I'm really focusing on, and that's what I'm going to talk about with you in more detail in the next couple of weeks. So if you got questions, type them out below this video in the comments section. I'll answer them and talk to you more about what's going on in the markets in more detail as the weeks go on. So, be talking to you later.